So welcome to the BDO Financial Reporting Update webinar. My name is Raisa and I'm joined today by Moses, who I'm sure is a familiar face to you and a voice. And we're from BDO's Technical Financial Reporting team. We've got quite a jam-packed agenda today, so we expect today's session to last between 55 and 60 minutes, including Q&A. And just to start with some housekeeping, the recording of this webinar will be made available online. If you've got any questions that you'd like to ask, you can use the Q&A functionality within Zoom, and you can access this from the icons at the bottom of your screen. Time permitting, we will try to answer all the questions during the session, or we'll get back to you after the webinar. Remember that if you ask your question anonymously, then we won't be able to get back to you after. And then lastly, remember that this webinar is available for CPD self-certification, so you can self-certify with your company. And that's it for housekeeping. Let's have a look at what we're going to be covering today. So we'll start off in the world of IFRS, specifically looking at the new standard IFRS 18, as well as some other developments within IFRS. And then Moses will take you through the developments in UK GAAP, specifically an overview of the amendments to IFRS 102, and a deeper dive into the new lease accounting model. And then lastly, we'll touch briefly on some developments in the sustainability reporting space. Okay, so then we'll start off with IFRS and specifically IFRS 18. Okay, and so if we move on to the next slide, IFRS 18 is a brand new standard on presentation and disclosure of financial statements that was released in April of this year, and it replaces the existing standard on presentation, which is IAS 1, which I think a lot of people are fairly familiar with. Now, the new standard doesn't deal with recognition and measurement, so that's good news. It's really making changes to the look and feel of the financial statements, in particular, the statement of profit or loss. Now, the IASB embarked on this project really to increase transparency and comparability within the financial statements. And when we talk about some of the changes, we'll come back to sort of talk about how they really achieve those objectives, being transparency and comparability. The new standard is effective for periods beginning on or after the 1st of January 2027, with the restatement of comparative information. So for entities with a calendar year end, you would restate your December 2026 period as comparative information within your 2027 annual financial statements. If you are an IAS 34 reporter, then you'll be adopting a little bit earlier, so either in your quarter one or half yearly interim financial statements within 2027. Given that the effective date is still some ways away, what we're going to be doing today is covering a general overview and sort of a whistle-stop tour of the new standard. And then as we get closer to the effective date, we'll be delving a lot deeper into some of the practicalities and some examples around really how these changes are going to impact you. A reminder that aside from this new standard, there are also some consequential amendments to other standards, including the standard on the statement of cash flows being IAS 7, and we'll touch on that briefly. So if we look at sort of how this new standard is made up, we've got our existing IAS 1, and many of the principles have continued to be incorporated within our new standard without significant change. So we've got some aspects that are fairly similar. We've also got some aspects that are currently in IAS 1 that will now be incorporated into IAS 8. That's going to be renamed the basis of preparation of financial statements. And then built on that are some brand new requirements where there are some substantial changes, and we're going to look at those today. So starting off with some of the topics that were really brought forward without a significant change from IAS 1. So starting at the top, the definition of what a complete set of financial statements hasn't changed. So we've still got our statement of financial position, statement of profit or loss, statement of cash flows, statement of changes in equity. So there's no sort of additional or name changes to kind of our primary statements. The requirements to report at least annually and to provide disclosures when you have a longer or shorter accounting period have also remained the same. The requirements to include comparative information in your primary statements and your notes have stayed. And most of the presentation requirements for your balance sheet, your statement of changes in equity, OCI, and the cash flow statement have remained the same. The guidance on classification of assets and liabilities as current and non-current, which is something that has recently changed and we've chatted about, that's remained the same. And then lastly, disclosures on how you've managed your capital have remained. So at least we know these are going to be fairly familiar concepts in the new standard. But then if we move on to the next slide, we'll see where are the areas that there are some significant changes. And we'll start off by looking at the first two areas of significant change that are listed on the slide. So IFRS 18 requires income and expenses to be classified and presented in 5 categories. And so you'll almost have 5 distinct areas within your statement of profit or loss. Remember, we said a lot of these changes are impacting the statement of profit or loss. And so these 5 areas are operating, investing, financing, tax, and discontinued operations. And we'll have a look at what this will look like. Now, those terms, operating, investing, financing, are terms we've heard before in our cash flow statement, but there is no explicit alignment between the categories in the statement of profit or loss and those in the cash flow statement. And the reason for this is because each of those statements have very different uses for the investors. So when investors look at your P&L versus when they look at your cash flow statement, they're looking for different types of information, and hence there isn't this explicit alignment. But saying that, the IASB is going to be looking at the cash flow statement standard, so IAS 7, and may make some changes. So we may see some changes to that alignment going forward. Now, we'll delve in future sessions into what is operating, what is investing, and what is financing. So we're not going to get into too much detail on that, but just to be aware, there's going to be these 5 distinct areas in your statement of profit or loss. Now, once you've sort of classified your items of income and expenses into these categories, there'll now be some subtotals that will be presented within your statement of profit or loss that are now mandatory. Specifically, IFRS 18 introduces 2 new subtotals, being operating profit or loss, which is a subtotal of all your income and expenses that are classified as operating. And then we've got a subtotal called profit before financing and income tax, being a subtotal of operating profit or loss and all your income and expenses classified as investing activities. And this doesn't apply to the financial services sector. Now, again, those terms sound really familiar. I mean, operating profit is a term that a lot of entities use. And in fact, the IASB found, in their sample, most of the entities had some type of operating profit or loss in their statement of P&L, but they found that there were varying definitions as to how people really defined what was included in operating profit or loss, and hence why this is now going to be very defined. So let's look at the next slide as to what this new sort of statement of P&L will look like. So here we've got quite a simplified example, and you can sort of see the distinction between operating, investing, financing, tax, and discontinued operations. Doesn't look all that different from what we're used to, but I think the key here is really around consistency and comparability. Coming back to what the objectives are, is that there is now really defined terms. So you're going to look at the definition of operating and decide what sort of goes into that section. Whereas potentially at the moment, there's a bit more flexibility. So for example, entities might decide to put things, as we say, above the line or below the line, and there may be some judgment there. I think there's now a lot more prescriptive guidance on where things are going to be shown within your statement of P&L, and hence making these mandatory subtotals, as you can see on the slide, of operating profit and profit before financing and income tax more comparable between entities. So this is a fairly simple example. It doesn't apply to financial services entities. So our banks and insurers would look a little different for them. It doesn't necessarily show all the complexities, but really just gives you a flavor of what it will look like. All right, so then if we move on to looking at some of the other areas of significant change, so the standard also introduces some more prescriptive guidance around labeling, aggregation, and disaggregation, and it gives some really specific guidance on how you should be aggregating. So you should be aggregating things that have shared characteristics. When should you be disaggregating? It also talks about the fact that you really shouldn't label things as other, unless you really can't find a more useful name for this other category that we sometimes see popping up. The other change is that you can still classify your income and expenses by nature or by function, but if you use the function approach, so your cost of sales approach, as sometimes people refer to it, there are going to be some additional requirements where you disclose certain line items separately if they're material. Then there are some consequential amendments to our statement of cash flows, so IFRS 7, because currently there's a number of accounting policy choices within that statement that result in diversity in practice and potentially reduce comparability. And so now IFRS 7 is a lot more prescriptive. So for example, if you use the indirect method, you have to start with operating profit or loss. So that is now very clear that that needs to be your starting point. The accounting policy choices around how to classify dividends and interest will now are now removed. So dividends and interest received would be investing activities, unless this is part of sort of your main business. And dividends and interest paid would be classified as financing activities, again, unless they're part of your main business. And then lastly, but certainly not least, the standard introduces the concept of management performance measures, or MPMs, or what currently some people call APMs, or alternative performance measures. Now, MPMs is a topic that we can talk a lot about, and we will delve deeper into it in future sessions. But at a high level, the standard provides guidance on the disclosures that should be included for those MPMs that are in scope of IFRS 18. So you now have to include those within the financial statements and include disclosures such as a reconciliation to the most comparable IFRS total or subtotal. Now, the interesting thing about these types of measures, so these are really adjusted measures that management uses. So it might be an EBITDA, it might be an adjusted profit. Often we haven't seen those in the financial statements themselves. They're often elsewhere. So they might be in an investor presentation, they might be in other parts of the annual report. And if they're now in scope of the new standard, they're going to have to be disclosed within the financial statements, and you're going to have to provide this reconciliation. So when we talk about in scope MPMs, the key ones that fall within here are the ones that talk about the financial performance of the entity as a whole. So it's not looking at things like free cash flows, or maybe you've got some adjusted balance sheet ratios. Those aren't in scope. It's really measures of financial performance that are in scope and now are going to potentially be disclosed within the financial statements themselves. So the inclusion of these MPMs in the financial statements could be a significant adjustment for many entities, as, like we said, historically, this information is sort of elsewhere. And these requirements will also impose a requirement on auditors to be aware of the public communications that entities make, which may then trigger the requirement for these MPMs to be disclosed in the financial statements. Because, like we said, these MPMs are not just the ones that are currently in the financial statements, but ones that are in other types of communication outside the financial statement. So there's that completeness risk around the various public communications an entity may make. Okay, and then on this slide, we've listed some of the practical things to think about when the standard, is starting to be implemented. So while it doesn't change recognition and measurement, it can still affect systems and processes. And we've listed some of those implications on the slide. So, for example, financial reporting systems may not be designed to appropriately tag and categorize your income and expenses into these 5 categories that we spoke about. It can also get quite complex if you think about groups with multiple financial reporting systems that now need to be consolidated. And so it may necessitate some changes to group reporting and the consolidation process. In defining items of income and expenses into operating, financing, investing, that could potentially differ between the separate financial statements and the consolidated financial statements, depending if the entities within the group have various different operating activities. Another consideration is this need that we chatted about to identify these management performance measures that are now within the scope of IFRS 18. And so an entity may need to design new systems and processes and controls because these are now going to be part of the financial reporting process, whereas potentially previously they weren't. All right. So that's really a very quick whistle-stop tour of IFRS 18. And again, we'll be delving into all of these things into a bit more detail. But let's now look at some other developments in the IFRS space. Okay, so starting off with some amendments to IFRS 9 and IFRS 7 on the classification of financial instruments. Now, the IASB conducted a post-implementation review of IFRS 9, and so some of these amendments relate to the issues that they discovered during that post-implementation review, but they also cover some areas where stakeholders had raised concerns or where new issues had emerged since IFRS 9 was issued. And there's really 3 parts to these amendments, and we'll touch on each one separately. So if we start off with the first one, which is an amendment that covers derecognition and recognition actually, but specifically the derecognition of financial liabilities that are settled through electronic transfer. Now, this amendment does 2 things. Firstly, it clarifies sort of the general guidance on when financial assets or financial liability should be recognized and derecognized. And then it says, here's an exception for certain financial liabilities that are settled using an electronic payment system. And so let's have a look at an example on the next slide as to what this all means practically. So we've got a very simple timeline here. And we've got a company that settles its trade payables using an electronic payment system. So it initiates payment on day 0, and this payment takes 3 days to clear. So on day 1, the payment can't be stopped or canceled. It's sitting within the banking system. And on day 3, it's completed. It's now reflected in the creditor's bank account. And there's nothing further for us to do. So the amendment clarifies the general rules. So under the general rules, the company would derecognize the trade payable on day 3. So not when they've initiated payment, but only when the payment is completely done and dusted. So they would derecognize the trade payables on day 3. But then the amendments say, well, if you're settling a financial liability using an electronic payment system, there is this exception. So the exception allows a company to derecognize a trade payable potentially at an earlier date if all the criteria on the slide are met. So one is that there can be no practical ability to withdraw or cancel or stop the payment. There's no practical ability to access the funds that have been used to settle for that payment, and the settlement risk is insignificant. So if you meet all those criteria, then you have a potential that you can de-recognize your trade payables at an earlier date. And in this example, potentially that's day one. So of course, if you're over a year end, this becomes, a much more significant assessment. So as a result of these amendments, entities will need to consider how the new requirements impact their financial reporting systems and processes, such as your bank reconciliation. You may also need to review the terms and conditions of the electronic payment system that you use to determine if this exception criteria are met and when they would be met. Remember, this exception is an accounting policy choice. So you could just apply the default, but if you want to apply this exception, it's an accounting policy choice. And you make that choice on a system-by-system basis. So whichever electronic payment system you use, you'd make a choice for that. The other implication potentially of these amendments really are because they've clarified the general rules on when assets and liabilities should be de-recognized and recognized is when you've got checks in transit. And so there might be some judgment in determining when can you de-recognize a trade receivable or a trade payable that are settled by checks that have not yet been cashed. They might be sitting in a drawer somewhere. And so there may be some judgment required if you do make payments using cash or receive rather checks. A reminder also that in the UK, the back system receipts really means, so if you're receiving money, you can actually only recognize that cash when it's actually arrived in your bank account. So that's on the cash side. And then we've discussed sort of some of the considerations around either your trade payable or your trade receivable. All right, so lots to think about there. Then the other part of the amendments, we've spoken about derecognition. There's also some amendments to the classification of financial assets. And again, there's really two parts to these amendments. So one is they clarify how assets with ESG linked features. So for example, if you have a loan that is linked to a specific ESG target of the borrower, what does that mean? And we'll look at that in a little bit more detail because these types of instruments are becoming more popular. And then secondly, there's also some clarifications around specific considerations when you're performing these classification assessments if you've got assets that have non-recourse features. We're not going to cover sort of that second part in today's session. We're really going to focus on the ESG linked amendment on the next slide. Okay. So why is an amendment required for these types of instruments? So under the existing IFRS 9 guidance, we perform our SPPI test or our solely principles of payment and interest test. And that really tells us, can we measure a financial asset at amortized cost? Or if we fail that test, we have to measure it at fair value. So it's quite significant. Now, when you've got these financial assets that have ESG linked features, so like we said, potentially one where the interest rate is indexed to an emissions target, then it's sometimes not entirely clear whether you meet the SPPI criteria and therefore can you measure this instrument at amortized cost, or because it's kind of got this kind of funny feature, do you then end up having to measure it at fair value? And so this is really what this amendment is trying to clarify, is that where you've got these financial assets that have contingent features, such as the ESG target, in performing the SPPI test, there's now some additional questions that you would need to ask. So under the amendment, certain financial assets, including like the one we've just chatted about, could now still meet the SPPI criteria, provided that their cash flows are not significantly different from an identical financial asset without such a feature. So that's a lot, but what the standard then does is it's saying in determining that, so are the cash flows, not either significantly different or not, there are really three questions that you can ask yourself, and those are listed in this decision tree on the slide. So if we start off with our example, which is I've got a loan and the interest rate is then indexed to an emissions target. And we ask ourselves this first question, and it says, do the contractual cash flows both before and after the contingent event meet SPPI? So if we look at our cash flows on this loan before we meet the target or after the target is assessed, am I still paying solely payments of principal and interest? So in my very simple example of where you've got a loan and the interest rate is indexed to an emissions target, you'd answer yes to that question because you're simply paying principal and interest. It's just that your interest rate may change. So you'd answer yes. The second question is then, is the nature of the contingent event, so in our case, the emissions target, related directly to a change in basic lending risks or costs? So we'd likely answer no in the scenario because that emissions target isn't really relating to lending risks or costs, so it's not looking at the borrower's credit rating or any kind of credit risk event. It's quite separate from that. So it's not sort of your basic lending risks or costs. So we'd answer no to that question. And then we'd look at, are the contractual cash flows significantly different from those of an identical financial asset without this type of contingency? Now here, this is where there may potentially be some judgment because there's no bright line on what significantly different means. And so we have to assess that if it didn't have this ESG-linked feature, what the cash flows would be. Now that it does have the ESG-linked feature, what are the new cash flows, and compare them and determine if they are significantly different or not. Given there's no bright line, we consider both quantitative and qualitative factors in making this assessment. And then depending on that answer, we'd either say, yes, this asset still meets our SPPI and therefore can be measured at amortized cost, or no, we now have to measure this instrument at fair value. So this amendment, again, just talking to some developments since the original IFRS 9 was issued as more and more of these instruments get issued in the market. Okay, so definitely lots of food for thought there. And then lastly, there's also some additional disclosures that are introduced as always, with these amendments will come the additional disclosures. Now, this amendment applies for reporting periods beginning on or after the 1st of January 2026. So also still a bit of time to wrap our minds around this, but as you can see, there'll be some judgment and they can be fairly complex. Okay. And then lastly, just some other developments within Q2 in the IFRS space. So on the 9th of May 2024, the IASB issued IFRS 19, which is a voluntary standard that permits eligible subsidiaries to produce reduced disclosures while still applying the recognition and measurement criteria of full IFRS. This standard can be applied from on or after the 1st of January 2027, with earlier application permitted. Now, what's important to know in the UK environment is this standard has not yet been adopted for use in the UK. If it is endorsed, it will provide an alternative to FRS 101 as a reduced disclosure framework for UK subsidiaries. But unlike FRS 101, it's not available in its current form for parent company accounts. So it's yet to be seen, the extent to which the standard will be taken up in the UK, given there is already a reduced disclosure framework. Okay, and then lastly, we've got an ED for some amendments to IFRS 9 and IFRS 7, specifically looking at contracts for renewable energy, given that these have some very specific, unique characteristics rather, and sometimes the hedge accounting requirements, or rather the own use exemption within IFRS 9 it's not always clear how to apply that, and so these amendments really deal specifically with that, so it's a fairly niche in that respect. Okay, and that's it from me. We're now going to be moving on to UK GAAP, and I'll hand you over to Moses.
Thanks, Raisa. As Raisa said, we're moving on to developments in UK GAAP, which after, I suppose, a period of relative calm, we're now facing significant changes to IFRS 102, which is the standard applied by most UK companies. So if we move on to the next slide, in terms of what we're going to cover today, we will have spoken in previous webinars about FRED 82, which is the periodic review of IFRS 102 carried out by the Financial Reporting Council, and the proposals set out in FRED 82 have been mainly brought into the amendments to IFRS 102. And so what are the headlines? Section 23, which was revenue, has been basically rewritten wholesale and replaced with a new section 23, which is based on IFRS 15. So for those of you who are familiar with IFRS 15, you'll know what it's all about. If you're not familiar with IFRS 15, this then brings in a whole host of new requirements in terms of disclosures, but also a new way of looking at your revenue contracts. So it's something to get your teeth into. The next big thing is IFRS 16, and that's what we're going to be doing a deeper dive into today, although I hasten to add mainly on the lessee side. So there are some changes to lessor accounting, which we'll cover at a future webinar. But again, if you're familiar with IFRS 16, you know what I'm talking about. But basically, IFRS 16 brought most leases onto the balance sheet, whereas in the past we had the distinction between operating and finance leases for lessees. That has gone, and most leases need to come on balance sheet, and we'll dive into that a bit later. And then there's other incremental improvements and clarifications. In terms of when the standard comes in, the amendments come into effect for periods beginning 1 January 2026, so therefore December 26 year ends effectively, which is not it's a very long lead time. A couple of them come in earlier, and I'll touch on those a bit later. Early adoption is permitted from now, so if you are really keen and want to change what your accounts look like, you could do that right now. But early application is only permitted if all amendments are adopted, and the reason for that is because some of them are phased in. So if we move on to the next slide, I'm just going to touch on these incremental improvements first. So there's 5 that were highlighted by the FRC, and we've put them here on this slide. The first one is to do with the conceptual framework to align it to the IASB's framework. So I suppose not something that will affect too many preparers, unless you have had to dive into the conceptual framework in the past to formulate your accounting policy. You might have to revisit that accounting policy in the light of the new framework. But generally speaking, the standard is quite comprehensive. It covers most types of transactions. The next one is a new section 2A on fair value measurement. Again, just updating to reflect the principles in IFRS 13. So we've got now alignment with IFRS 13, whereas in the past we didn't in terms of some of the definitions. New disclosures about supplier finance arrangements is the third one. That's one of the ones that comes in early from 1st of January 2025. So that's something to watch out for next year. And again, this is consistent with the direction of travel with the IASB, where as a result of several large corporate failures, one of them being Carillion, there were questions being asked about the transparency of the disclosures around supplier finance arrangements and whether bank or indebtedness as opposed to amounts owed to suppliers were being misrepresented. So this amendment will hopefully go some way to clarifying that. The fourth one is, again, a rather opaque one in terms of how many. It's removing the option to adopt the recognition and measurement requirements of IAS 39, and there are, just as a reminder, IFRS 102 allows you to either adopt sections 11 and 12, or do IAS 39 or IFRS 9. So the option to adopt the IAS 39 recognition and measurement is being taken away. But if you've been doing IAS 39 so far, then you will still be able to carry on doing it. And then the last amendment here is about some disclosures for Section 1A for smaller companies. Again, not going to go into those in any great detail. So if we move on to lease accounting now, like I said, this is mainly focused on lessee accounting. We will deal with lessor accounting and transition in a future webinar. Next slide, please. And this is just a headline, a summary page in terms of what's changing. So scope, some leases of certain assets not being scope. We'll cover that on the next slide. It may be applied to leases of some intangible assets. Again, not something you see too often anyway. Recognition, what's going to change? Well, for lessees, most leases are going to come on balance sheet. For lessors, the status quo will remain, although there will have been new paragraphs inserted that you might need to look at just to make sure that your previous accounting, especially if you were exercising judgments because the previous section 20 of the standard didn't cover the transaction, then there might be a bit more clarification going forwards. In terms of comparing it with the IFRS 16, there's some optional simplifications, but they're optional. So if you wanted to align it, say, because you are an IFRS 102 preparer, but your parent prepares accounts under IFRS, there's some options that you can either deviate from IFRS 16 or stay in line with IFRS 16. And transition, again, something that we cover, I suspect, in more detail in a future webinar, but here are the headlines there. In terms of adoption, it's called retrospective, but it isn't retrospective as we might know it. The way it's going to happen is that, say, for your December 2026 accounts, you will have comparatives, let's say P&L and balance sheet, prepared under the current Section 20. But then when on the first date, so of your financial year ending December 26, so on 1 January 26, you bring in your assets and liabilities at that date and account for the leases prospectively from 1 January 26. So we're not going to be restating comparatives. There's also an option for subsidiaries or entities whose parent prepares accounts under IFRS 16 to use the IFRS 16 numbers for the leases that are yours on your balance sheet. Again, that's something that may be useful, may not be useful. We'll see how it pans out. And otherwise, if you're not applying the group exemption, then you will recognize an asset equal to the liability on transition, adjusted by the amount of any prepaid or accrued lease payments. If there's any difference between your asset and liability, that will go as a debit or credit to opening retained earnings or another reserve. So moving on, in terms of on to the next slide, please. So which leases don't have to come on balance sheet? So we've got two short-term leases and low-value leases. Again, this is aligned with IFRS. What's a short-term lease? A lease, it's where the lease term is 12 months or less. There's no purchase option. If there are extension options, then you've got to assess whether you're reasonably certain to exercise them. But if you meet the criteria where you've got a lease where the term is less than 12 months, then you can keep that off balance sheet. What do you do then? You basically straight line like you probably would at the moment. This exemption needs to be applied consistently by class of underlying assets. So it's not a pick and choose piece for given leases. So if you have, say, short-term property leases, then you either apply the exemption for all of them or for none of them. But you could have short-term leases for, say, cars, and for property you could choose to apply it for property but not for cars, or vice versa. In terms of low value lease, what is a low value lease? Not defined is the answer, but you would assess whether the underlying asset is of low value by reference to a new asset. So if you take out a lease on a 10-year-old car, which isn't worth very much, you would look and say, well, how much would that car cost new, and would that then meet the definition of a low value asset? By the way, that was a very bad example, because cars are not cannot be a low value asset. In fact, the standard gives a list. So what cannot be a low value lease? Cars, lorries, cranes, bulldozers, forklifts, tractors, boats and ships, trains, airplanes, land and buildings. So other things, photocopiers, PCs, could be. This is slightly different to the definition in IFRS. Well, IFRS actually doesn't define it, but in the basis for conclusions, there's mention of a $5,000 cap, which has been taken to be a sort of a hard and fast rule under IFRS. The FRC was intending to perhaps be a bit more flexible and allow, let's say, assets that are worth more than that $5,000 to remain off balance sheet. Worth pointing out that this is not a materiality assessment, so you could have hundreds of low value assets and you could keep all of them off your balance sheet if you chose to. And the assessment is also done on a lease by lease basis, in contrast to the short-term lease exception. There's a bit of anti-avoidance written into the standard, so you can't say, well, you know, I'm renting a car, but it's actually a collection of nuts and bolts and lots of other components, and each component is low value, therefore I have no lease. No, you can't do that. You know, in such a case, you know, that last bullet on the right here, the underlying assets can't be highly dependent or integrated to other assets. Just something to bear in mind, but again, we haven't seen too much of a problem applying this. So moving on to the next slide. So what's a lease? So the first thing is the introduction of the concept of an identified asset. And what's an identified asset? This could be the asset could be explicitly or referred to in the contract, or it might be implicit. Also worth pointing out that if you have if the supplier has substantive substitution rights, then you do not have an identified asset. But the conditions that you need to meet to say there are substantive substitution rights are quite hard to meet. The supplier has to have the practical ability throughout the period of the lease to replace it. So if the asset could only be replaced at given intervals, then you would have an identified asset and you wouldn't have substantive substitution rights. The second condition is that the supplier would need to be able to benefit economically from the substitution. Again, that's an assessment that may be hard to make, and the standard says if you can't make that assessment, then assume that no substitution rights exist. The other two tests are, you know, does the customer or the lessee obtain substantially all the economic benefits? If you can answer yes to that, and do you then have the right to direct the use of the asset? Then if you answer yes to that, you have a lease. If you answer no to any of the three questions, you don't have a lease. That last question, or that last criterion there, is for situations where you might have a contract where there's an implied lease or implied asset or even an explicit asset, but it's not clear who's operating the asset or who's directing the use of the asset. So there's some guidance there to apply. Again, and this is something I probably should have mentioned earlier. I suppose in the past, because one has been, most leases were operating leases, at least for, let's say, for equipment, then the assessment of whether there was a lease within a contract wasn't perhaps done very thoroughly, because you were anyway spreading the cost throughout the period of the contract. Now with the introduction of these amendments, you probably need to look at that a bit more closely. So then moving on to the next slide, we're talking here about lease components. So if you have a contract that contains a lease, then you've got to account for each lease component separately, and also separately from non-lease components. So what does that mean? You can have a lease on a building where you are being provided with common area maintenance by the landlord. In theory, so if that building has 6 floors, potentially each floor is a separate lease component, and the maintenance services are a non-lease component, because it's a service you're receiving. There is a practical expedient included here where the lessee could, by class of underlying assets, choose not to separate non-lease components from lease components. So what you could do is include, say, the cleaning cost in your lease liability. Again, not something that one sees too often, or haven't seen it too often under IFRS 16. Again, it remains to be seen whether this will be an election that will be made by a lot of preparers. Moving on to the next slide. So then we've got determination of the lease term. So the definition of the lease term is not significantly different from what it was under Section 20. So what is a lease term? It's the non-cancelable period of the lease plus options to extend if you're reasonably certain to exercise, and termination options if you're not reasonably certain to exercise. So again, it's not, this isn't a big change. Just a reminder that the assessment of lease term is done at the commencement date of the lease, not lease inception. So you might sign a lease but not take the keys, say, to the property for 3 months. You make that determination at the commencement date, and the commencement date is also the date when you recognize your right of use asset, or your lease asset, and your lease liability. In terms of when you reassess the lease term, so you're required to reassess the lease term when a significant event or change in circumstance which is within the control of the lessee occurs, and that change affects whether or not you are reasonably certain to exercise any options to extend, or options to terminate. Worth pointing out that lessor options to terminate are ignored in the determination of lease term. This is a determination that is made by both the lessor and the lessee from the perspective of the lessee, which is something that sometimes isn't always well understood. So moving on to the next slide, we now move on to measurement. And while the standard sets out measurement for the right of use asset first, and then for the lease liability, you've got to start with the lease liability. So that's what we've done on this slide. And what do you include in your lease liability? You include fixed payments from the commencement date over the lease term as determined per the previous slide. Some variable payments we've got there. Which ones? Those that are dependent on an index or rate, and you include those based on the index or rate at the commencement date, plus any residual value guarantees, plus any purchase option prices if in your assumption of lease term you've assumed that you're going to exercise it, plus any termination penalties, again if in your assumption of lease term you've decided that you will exercise an early termination option. that becomes your lease liability, of course, discounted, and we'll touch on the rate at which you discount on the next slide. And then your right of use asset, which is the other side of the equation, is your lease liability, which is that last blob on the right, plus your initial direct costs. Those are only incremental costs that you incur. So looking at a property lease, you might include surveyors' fees, lawyers' fees, property agents' fees, but you wouldn't include, say, search fees, because those are not incremental to the lease that you actually take out. Then any costs to restore or remove the assets, so restore the assets to the condition it was, or to remove the assets. Again, those are future costs. The other side of this entry would go to, say, a provision in the main. You then add also payments made at or before commencement day. So you might have paid some key money or something up front. You would then add that. So you might have classified it as a prepayment or some other assets before, and then you would reclassify that to your right of use assets. And then you deduct any lease incentives received. Worth pointing out that the definition of lease incentives is different now, but again, in substance, shouldn't lead to a major change in terms of what you might have considered a lease incentive in the past. But the new definition focuses on it being a cost of the lessee. If it is not a cost of the lessee, then it would be unlikely to meet the definition of a lease incentive. So some judgment may be required, and again, something that you may not have thought about too closely before, but now you might need to, because it will affect the numbers on your balance sheet. So moving on to the next slide, we're just going to touch a bit more on the various types of payments that the standard envisages. So you've got variable payments that depend on an index or rate. Those are included in your lease liability using the index or rate as at the commencement date, and you would then remeasure in the period that the rate or index changes, and you would then end up adjusting your lease liability and your right of use assets. The amendments also introduced the concept of in-substance fixed payments. Again, this is mainly an anti-avoidance provision, so that payments aren't structured to look like they're variable, but they're not really variable. So again, that's something to perhaps go into more detail at another point in time, but you would include those if you determine those are in substance fixed. And then you've got other variable payments, let's call them contingent rents, let's say, or turnover rents. Those are excluded from the measurement of the lease, and you recognize in profit or loss when the condition that triggers the payments occur. So normally, if it's a turnover rent, you would do it in the period that the turnover that gives rise to the payments arises. So moving on to the next slide, in terms of what discount rate do you use, the preference is the interest rate implicit in the lease. Now that you may be readily determinable if, let's say I've seen them say for motor leases or equipment leases, you can sometimes determine that quite readily. Otherwise, if it's not readily determinable, then the standard gives you a choice of incremental borrowing rate, which is the rate of interest the lessee would pay to borrow funds necessary to obtain an asset of similar value for the lease term, or the lessee's obtainable borrowing rate, which is defined as the amount of interest that the borrower or the lessee would need to borrow in order to pay the undiscounted lease payments. This latter one is a simplification from IFRS. Again, it remains to be seen how much take-up there will be on this. Determining an incremental borrowing rate, which is also required in IFRS, has not proven to be a big stumbling block for most preparers we have come across. So moving on, and I realize we are running a bit short of time. So for lessees, subsequent measurement for the right of use assets, you can use the cost model or the fair value model. For the lease liability, again, I think we all know how to account for a finance lease, so you would increase the lease liability by interest and reduce it by payments made. Then there are remeasurements to be made, either on reassessments or lease modifications, I suggest we'll go into detail on that in a later webinar. So moving on to the next slide. So what's your balance sheet going to look like? Well, you're now going to have an asset for your leases, and you have a choice there of either including it with, let's say, within your what we would call tangible fixed assets, or you could have a separate line for it. You then also have to have lines for lease liability or include within other liabilities, and then there'll be disclosure requirements in the notes as to what you say about them. So your P&L, well, what's that going to look like? Well, for those of you who report EBITDA, the FRC have, at the stroke of a pen, increased your EBITDA because you no longer have rent expense, but you will have amortization of the right of use assets and interest expense on the lease liability. In terms of the cash flow, and this is probably where there's a fair amount of change here. So those lease payments, which you would have previously included in operating, let's say for your property leases, those now move in part to financing activities because you're now paying off a lease. You're not paying an operating lease, and then the interest element of those payments. Well, that will depend on your policy on presenting interest payments. Some people, you're allowed to, under the standard under Section 7, to either include it in operating or in financing. So, and you would have to be consistent with your previous policy for accounting for disclosing interest payments. Worth noting, though, that if you've taken the short-term low-value exemption, those payments would go in operating activities as they have in the past, and equally contingent payments, like as I said, like the turnover rents, they will also go to operating activities. So if we move on to the next slide, just a few things to think about. Tax, again, don't take this as a view on the tax, but for UK companies and UK preparers, we probably shouldn't see too much change on tax. But if you, let's say, are consolidating overseas subsidiaries, there may be either some current tax or foreign or deferred tax impacts. Dividends, how might that manifest itself as a problem? Well, if you have an adjustment, say, to opening equity on transition, potentially that could become a dividend block. Other things like profit-related contracts, earnouts, if they are based on old GAAP, shall we say, or old the previous version of 102, then you might need to keep dual records. And equally, looking forward, you might want to future-proof those earnout tests by referring to the amended IFRS 102. Communication, again, in terms of communicating to stakeholders about performance and the shift, say between if you're reporting EBITDA, that your users might see an EBITDA number that has gone up, and you're saying no, profitability is still the same, so there might be some communications issues there. Covenant compliance, again, this is something we saw on adoption of or transition to IFRS 16. Some borrowing agreements might have a frozen gap clauses, so again, you might need to be keeping dual records there. And the last one there, consequences of negotiating lease contracts. I suppose in the past it was all fairly straightforward, particularly if it was an operating lease, you would just be spreading over the remaining term of the lease, or if there was additional or reduced lease payments, you would find a way of reflecting that in your P&L. Now it's going to affect your balance sheet, so you might want to be thinking about or modeling out what the renegotiation would look like. Moving on to the next slide, and the next one after that, other updates, and this is just on sustainability, an update that the UK government announced last month, the establishment of two committees, an independent technical advisory committee and a policy and implementation committee that will assist with the assessment and endorsements of IFRS S1 and IFRS S2. The government aims to make the endorsed standards available in Q1 2025. Now, how that then will fit into the reporting ecosystem still remains to be seen. For example, are we expecting the FCA to amend the listing rules, or are some of the will the Companies Act be amended to reflect IFRS S1 and S2? We don't know yet, but that's something that's coming up in the future. That brings us almost to the end. If we just move on to the next couple of slides, just a reminder that our corporate reporting spotlight, our latest one is out at the moment. We'll include a link on the email, which we'll send you after this after the webinar. And on the next slide, again, just some other publications that we've put out in the last quarter. Again, there'll be links to that in the email or on the presentation itself. I can see that we've got some questions, but I think we will take them offline and respond to them, and then include them in the email. So with that, I'll say goodbye to you. Thank you for joining us, and we'll hopefully see you again soon.